Hello, Ed Yardeni here, coming to you live from, let me turn that off. Uh, Coming to you live from Long Island, and it's actually very cold here today. It's Monday, March 28th, and kind of waiting for the spring to happen. We had a couple of spring days kind of teasing us, but now it's cold, like in the 30s. So hence I've got my cardigan jacket on, kind of the Mr. Rogers look. It's a lovely day in the neighborhood, as Mr. Rogers used to say. I wish that was the case everywhere around the world. There's some pretty ugly neighborhoods around the world, and clearly the situation in the Ukraine isn't is still horrible. It's not widely recognized that this war has been going on for really quite some time, ever since Russia invaded Crimea and took over. There's been a shooting war, almost like a trench warfare situation going on in the eastern end of Ukraine in the Donbass region. And it seems that Putin, when all is said and done, wants to have at least that territory as part of Russia. And meanwhile, Zelensky seems to be willing to talk about making Ukraine a neutral country, but whether they can come up with some terms here, I guess some of their representatives are going to meet in Turkey. We'll see how that plays out. But the markets clearly handle this geopolitical crisis remarkably well. Commodity markets, on the other hand, have been just ripping to the upside here because of what's going on over there. Ukraine and Russia account for a lot of the wheat, so there's a lot of concerns that the soaring prices of grains is going to lead to not just more inflation, but actual shortages. From what I understand, there's actually plenty of wheat around in storage and all that, but if there's hoarding, that complicates the situation, because hoarding can compound perceived shortages, create shortages, and lead to still higher prices. And a good part of the Middle East gets its grain from the Black Sea region, in other words, from Ukraine and Russia. And so that could really create some more geopolitical tensions and crises in other parts of the world. Meanwhile, let's turn to our neck of the woods and focus on what seems to be the issue of the day, which is the yield curve. I'm looking at the spread here on my screen between the 10-year and the 2-year. That's got everybody's attention, and it's coming pretty close to 10 basis points. And the fear is that if it goes negative, then it's got a good track record of predicting that there will be a recession. Well, let's have a look at that. That's what I spent a lot of time on in Monday's morning briefing. So let's see if we can go there. And here's the chart package, March 28th. Make sure we're looking at the right one. So before we go to the 10 versus 2 yield spread, let's look at the yield spread between the 10-year and the federal funds rate. Why look at that? Well, it just happens to be the quote unquote official yield curve spread. It's the one that's in the leading indicators. And that's kind of the way I want to kind of frame this conversation, is that it's important to understand that this is just one of 10 components of the index of leading economic indicators. It used to be official in the sense that the government put this indicator together. Then several years ago, they farmed it out to the conference board. And I presume that the economists who put together the index of leading economic indicators did a lot of work on trying to figure out if you can come up with 10 indicators, which ones would you want to have in there? And I'm sure they did a lot of work on the yield curve, and they probably looked at all variations along the yield curve, and they came up with this 10-year minus the federal funds rate. And it does pretty well lead economic recessions. So the problem is it's not doing that now, even though the 10-2 is doing so. Let's move on here. By the way, figure 1 shows you the yield curve versus the business cycle. And just for fun, to relate it to what we do for a living, let's look at the yield curve versus stock market cycle. It's basically the same story. And by the way, the S&P 500 happens to be one of the components of the index of leading economic indicators. So it's not too surprising that when the yield curve turns negative, that's typically tends to be associated with a bear market in stocks. Let's look over here at the leading economic indicators and the coincident ones. And as you can see, the leading indicators are basically at an all-time record high. There's no recession there. They do tend to have a leading relationship to recessions. They peak out before and give you a little bit of a heads up. The problem is the data lags by about really a couple of months. I mean, right now we only have February data. We'll soon be getting March data, and then we'll be in April already. So it's not exactly a real-time indicator, but it's close enough. And here you can see the coincident indicators. By the way, I follow all 10 of the components here. I follow all 4 of the components in the coincident indicators. And we have had a V-shaped recovery in the coincidence. And you can see that we're moving into record high territory. So we've had our recovery. Now we're having our expansion. Well, here's the problem. Everybody's focusing on this 10-year minus 2-year. We're always looking for trouble and what could go wrong. And all of us are in this market. But you can see that the spread to 10-year minus 2-year, we have weekly data for constant maturity 2 years going back to 1976. And that looks pretty much the same as the official one. But this one was 19 basis points on Friday. And now it's already 10 basis points. Let's put it together. And you can see that they do tend to be quite similar. They tend to give the same signal in the past for recession. But now we've got this odd divergence. Wouldn't you know it? Just when we really want to know where we're going here, they're going like this. So it's the road not taken. We got to kind of choose sides right here. I'm going to stay with the official one that says that there's no imminent sign of a recession, as opposed to going with the 10 to 2 year. The official yield curve I've previously shown you is clearly very much influenced by the Fed and the Fed cycle. The say red shades are showing you where the Fed's been raising the Fed funds rate, and the blue shades show you where the Fed funds rate's been going down. And you can see that generally speaking, when we start in these blue shade areas, when the Fed's starting to ease coming out of a recession, you get the yield curve becoming steeper and steeper. Then somewhere along in the easing stance, it starts to flatten out, starts to narrow. And then when the Fed actually starts to raise the Fed funds rate, you continue to narrow, and then you invert. So I guess somewhere along here, or maybe even along there, the market seems to be signaling that if the Fed continues to tighten monetary policy, it could cause a recession. But that's not my interpretation of what the yield curve's actually forecasting. What I think the yield curve's forecasting, since it's very much focused on the credit markets, is if the Fed continues to raise rates, something will break in the financial system. There'll be a financial crisis. And you can look at this chart at your leisure time, and you'll see the financial crises that have been associated with something breaking. And those crises then become more general credit crunches. So even good borrowers have a tough time borrowing money. And that in turn leads to a recession. So that's kind of the progression of how I see things. And again, here the Fed is just starting to tighten. We've sort of extrapolated that they'll be doing so through the end of 2023. We'll change that if need be. But by the way, notice that 300, 400 basis points is kind of the peak in these kind of spreads. That gives you a pretty bearish outlook for the bond market, because let's say we all agree that the Fed funds rate will be down up to 1% by the end of the year. Some of you may think it'll be higher than that, but let's say it's 1%. 1% plus 400 basis points gives you a bond yield of 4 to 5%. I kind of find it hard to believe we're going to go that far up, but a lot of people were thinking that 2.5% might be it, and I don't think so. I think 3, maybe even 3.5% is where we're going on the bond market. So I don't see any reason to be jumping into that market just yet. This is just another look at the monetary policy cycle. Shows you exactly what I just said in terms of the reds marking the red shades marking the periods when the Fed's raising the Fed funds rate and so on. Well, another credit spread that we should pay attention to in the credit markets is this spread, the red one, which is the high yield corporate spread relative to the 10-year bond yield. And the problem with this is that it doesn't give you much of a heads up. It's a coincident indicator, but it's a real time indicator, and you have to kind of anticipate it. Now, should we be concerned about this upturn in the corporate spread? We've had upturns before that really didn't lead to much trouble. Sorry for all the mess here, but I wanted to show the extent to which that spread is highly correlated with the VIX, or the other way around, the VIX is highly correlated with what's going on in the credit markets. The situation might actually be a little bit worse than this is indicating on the credit quality spreads, simply because there's a lot of energy bonds here. And you might recall back here that we had this spread going up, and most of that spread was going up because the price of oil was collapsing, and energy junk bonds, those yields really blew out. This time around, everybody wants to own the energy junk bonds because the prices of oil is so high, so they're not going to have problems making their payments. So maybe this is a little bit worse, but I'm not seeing a credit crunch at this point. I don't think, I mean, the ruble crisis seems to already be over, and if even if it turned into a crisis, I doubt that would have caused a credit crunch here in the US or even on a global basis. We've had a property bubble blow up in China without creating any global consequences in terms of a credit crunch. And then there's just a tremendous amount of liquidity left over from the past 2 years that we've discussed before in my conversation with you about, well, we don't have the Fed put anymore, but we've got the CFO put. So there's a tremendous amount of liquidity. So I'm not particularly worried about a credit crunch. This is just another version of the same chart showing the VIX and the credit cycle, the credit quality cycle versus bear markets and corrections. Well, another possible source of a recession, I suppose, is soaring oil prices. And this is on a ratio scale. So you can see we had a huge increase here, a huge increase there, there, not so much here, but they are associated with recessions, whether they cause recessions or whether it's kind of a coincidental situation where during economic expansions and booms, we've had tendencies to have oil prices go up a lot. I'm not convinced that this is going to be a real issue here. Now, you know, there are already people talking about 150 to 200 or 300. When people start talking about that, we're probably getting pretty close to a top in the oil price, in my humble opinion. But there is lots of oil out there, certainly in the Middle East, and certainly here in the U.S. So I think at some point, high prices lead to more production and lower prices. The same thing can be said for some of these other commodities, but as I said, the question is hoarding, particularly now in the grain area. Meanwhile, personal consumption expenditures on energy goods and services as a percent of total personal consumption expenditures is pretty low. So I guess everybody's talking about how the price of gasoline is at a record high, and people are seeing now 5 handles, even 6 handles on the gasoline pump price, and that's got people nervous. But at this point, I'm not that concerned, but I'll show you why it's got my attention. Let's skip this one. Here's another leading indicator, by the way. I got 2 more for you that are not in the official index of leading economic indicators, but they're pretty neat. Look at this: payroll, employment, truck transportation versus leading indicators, all-time record high, and it tends to be a pretty decent indicator. So the hiring in the trucking industry, watch that as a leading indicator, and it looks pretty good. Watch the hiring in the temporary help services, all-time record high. So as I said, the overall leading indicators plus some of these other components that I'm looking at just don't show recession. The 10 to 2 is not an official part of the leading indicators, but we want to watch it. I'll show you one that I am concerned about. This is forward earnings. You know, I'm a big fan of forward earnings, analyst consensus expectations for earnings on a time-weighted average this year, next year. And this is just the growth rate. I don't often show the growth rate, but this is the growth rate versus the US leading economic indicators. And it's way up here. I mean, it's coming down, but it's nowhere near the kind of reading you get coming into recessions. Another one here is just forward earnings versus coincident economic indicators. And again, no recession. Here's what has got my attention here. This is the consumer sentiment index. There's two monthly indicators for sentiment, for confidence that we look at. One is the consumer sentiment index, and the other one is consumer confidence index. Debbie and I actually like to take an unweighted average of the two to kind of get an optimism index, just to get another slice and dice of what the data is showing, because they're different surveys. The consumer sentiment index seems to be much more sensitive to inflation than the CCI, the consumer confidence index, whereas the consumer confidence index seems to be much more sensitive to employment situation. So we know we've got a red hot labor market with a red hot inflation situation. And so not surprisingly, the consumer sentiment index is taking an absolute dive. The red is the overall index, and then there's the current conditions and the expectations. By the way, speaking of leading indicators, the expectations is included in the index of leading economic indicators. It's included as an average of the expectations in the CSI and the CCI. I hope I'm not getting you too confused on all this. But the bottom line here is consumers are very, very upset, nervous, depressed about inflation. And that does have a pretty good indication of a recession. And the consumer matters. And consumer could certainly cause a recession if they decide, you know what, there's too much inflation out there. My wages are going up, but they're getting completely offset by price inflation. I'm not really getting an increase in my real incomes. And so they may not even have the wherewithal to keep the economy growing if inflation outpaces wages. I don't think that's likely, because productivity typically means the wages rise faster than prices, but it's something to be concerned about. So the consumer, I think, is an issue, but look at the unemployment rate. It's near its cyclical lows, as you can see here. Now, here's the problem. Being near a cyclical low in unemployment shouldn't give us much comfort here, because the reality is we typically bottom right before recessions. Kind of makes sense once you think about it. So this is not necessarily a comforting development that the labor markets is getting to be about as good as it can get. But who knows? Well, I think I know. I think the labor market's so tight that we could see this thing drop below 3.8% to 3%, maybe even 2%. Could be an all-time record low, or it could be at least down here. So we're not necessarily at that inflection point between unemployment and recessions. Meanwhile, consumers are seeing, would-be home buyers are seeing mortgage rates soaring up, and yet the indications are people really still want to buy houses. They just can't afford them, a lot of them, but there's still apparently quite a bit of demand. What there isn't is supply. And so prices are up 33.4% over the past 2 years. That's certainly priced a lot of people out of the market. And on top of all that, we got mortgage rates going up now. So housing looks like it may be vulnerable. I don't know if it goes into recession, but it certainly may not be a source of economic strength. So we want to watch that. And this is pending home sales have been dropping. And again, that's not necessarily just affordability. It just may be just a shortage of actual inventories of homes for sale. Yeah, this is not a leading indicator, but I'm trying to do my due diligence here and make sure that I cover all the bases. This is another reason, I guess, to worry about a weaker economy. This is the yearly percent change in the 26-week average of rail car loadings, excluding coal. And that's kind of depressed here. It's not much of a leading indicator, but it's something to watch. Meanwhile, I needed to fill here, quite honestly, for my chart package, because I got a multi-panel coming up. But the good news is the pandemic feels like it's over. The bad news is it looks like there's another variant that's been swarming around the UK, and they seem to be a leading indicator for us. But a lot of people have been vaccinated here. I think there's been a pretty good herd immunity. So I think that could be a positive story for the consumer, and particularly spending on services. So what do we have here? We don't really have a recession, in my opinion. I think the outlook is a stagflationary outlook with slower economic growth, let's say 2% instead of 3%, and with higher inflation bottoming at the end of this year, not bottoming, but going down at the end of this year to something, let's say, like 4 to 5% instead of 3 to 4%. So more stagflationary is sort of the evolution describes the evolution of our forecast here at Yardeni Research. Meanwhile, there's an article that it appears in the Fed's notes, which is available on their website, and we discussed it in the morning briefing, which is very relevant. Steve Sharp is one of the authors. Occasionally, I've had communications with him. Very smart guy. He actually briefs the staff on a regular basis. So he's one of the. Let's do that again. He briefs the FOMC on a regular basis. So he's a staff person, and he provides a lot of input to the Fed. And he's apparently pretty influential with the Fed chair, because the Fed chair, Powell, quoted his recent updated study on what we want to look at the yield curve. And he and his partner basically said, don't even bother looking at the 10 to 2 year or the 10 to the Fed funds rate. He said, just ignore them. What really makes sense is to look at the very short end of the yield curve. Basically, this is their variable. They call it the near term forward, which is the forward implied 3-month treasury yield in 18 months. So 18 months from now, let's calculate what the yield curve is implying the 3-month yield's going to be doing, and then compare that to the current 3-month treasury. And in the paper, so here you can see they got the same divergence. They got their near-term forward showing that the capital markets, the credit markets are anticipating growth. They're not expecting to see over the next 18 months a drop in short-term rates, while the 10 to 2 is going the other way. In their paper, Sharp and his colleague point out that this should be pretty comparable to what you can get without doing any arithmetic whatsoever. All you got to do is look at the 12-month futures and compare it to the current Fed funds rate. And I've concluded that you can also look at the 2-year future versus the Fed funds rate. So while everybody is looking at the 10 versus 2, I'm looking at the 2 versus the Fed funds rate. And there's no sign of the markets anticipating that rates are going to be coming down in the next 12 months. Hence, there's no market signal that there's going to be a recession. So we can watch out for that. Well, talked a little bit longer than I wanted to. Let's see for some questions here. I see 2. If you want to throw in a couple more, I'll take them. These are long questions. Let's see. Most economists believe that the federal COVID-19 deficit spending has overfilled the M2 bathtub, which will take a while to drain. Considering several factors, including higher interest rates, how long do you believe inflation will last and at what rates? Is hyperinflation a possibility? Maybe a recession pulls the plug and drains M2 faster? If so, what are the projected costs? Well, it's a long question. Let me just take one or two parts of it. Yeah, I mean, that's really been my position that the past 2 years, we have filled up, as you say, that M2 bathtub with a lot of liquidity. And it's still there. I've previously said, if you take a look at an M2 chart and look where it is now, I think the latest data is February, and compare it to where it should be now, based on the pre-pandemic trend in M2, we're about $3 trillion above that. So that's a tremendous amount of liquidity. And I've also pointed out that if you're looking for it, you can find some of that in personal savings. The consumers got liquidity. And in addition, corporations have a lot of cash on their balance sheets, and they're generating a lot of cash. Hence my conclusion that the CFO put has replaced the Fed put. It does mean that there's enough liquidity that even if the Fed does 50 basis points at the next meeting, and then 25 or another 50 basis points after that, that the Fed is kind of late behind the inflation curve here, and that it's going to be tough for them to catch up to it without causing a recession if they get too aggressive in raising their interest rates. And I don't think they're going to be aggressive enough to really break the back of inflation, but I think it's going to moderate to a certain extent. But inflation is something we're going to have to live with here for a while. Okay, Paul, negative real wages eat away at consumer. Yeah, that's kind of the point I was making, is that a lot of consumers are seeing their wages go up in nominal terms, but then when they go shopping, they see that it doesn't have any more purchasing power than they had before the wage increase. We know that lower wage workers are actually getting bigger wage increases than higher wage workers, and the lower wage workers are just barely beating the inflation rate, whereas higher wage workers are not. When you look at total wages, it still shows a slight increase in real wages, and that's consistent with the view that productivity continues to grow, and that's my optimistic scenario for the decade ahead. The roaring 2020s is a scenario that I think will kind of rise from the ashes here as the decade proceeds, and that productivity will make a huge comeback. But for here now, real wages are barely growing. And we've seen a very decent recovery in the number of people working. Maybe there's a few more months of that. Beyond that, the consumer is not going to be able to give us much growth unless it's driven by real wages, which is what I'm counting on, but I'm data driven and I'm not seeing it just yet. I'll keep you posted. Let's see, Rocco, it seems that there's no sign of recession. Do you still stick with your 4,000 projections for S&P 500? Yeah, I mean, 4,000 to 4,800 is the kind of the range I see this year. I've been arguing that it's going to be a volatile year. It's going to be a year where the earnings situation may continue to hold up pretty well. Again, stocks are a good hedge against inflation, and their revenues certainly go up with inflation. And as long as we continue to get evidence that they're holding on to their profit margins, that must mean that they're offsetting their costs by pushing them into prices and or increasing their productivity. So revenues and earnings can grow at the same rate of inflation. That's obviously a great inflation hedge. And maybe that explains some of the reasons why the market's done somewhat better here in the face of inflation, in the face of the Fed saying that they're going to be raising interest rates. But what changed for me in the past couple of months is February and March is that inflation is going to be more persistent. It's going to be higher for longer. Therefore, it keeps the Fed in kind of a monetary tightening stance longer, pushes the bond yield higher. And I got to believe that's going to have some impact on the valuation multiple. The offset is all that liquidity that's out there still. But right now, we're still around a 19 forward PE. And we got down as low as 18. I wouldn't rule out the 16 or 17 as a downside PE for the S&P 500. The SMID caps look attractive within the sectors. Still like energy, financials, and I think beaten down technology stocks make a lot of sense for this productivity story that I see up ahead still. Let's go here to, I think I covered that one for Paul. Let's have a look at Vincenzo. After a few weeks into the correction, would you be surprised had the U.S. stock market simply reached new highs and continues to go up? Yeah, I mean, I'd be surprised, but you know, I'd be delighted. I do believe the market's going to be making new highs going into next year, but I think it's going to be tough to make new highs here with the kind of inflation outlook that I'm seeing. And let's face it, the geopolitical issues aren't done yet, and the consequences they're having for commodities and what that's going to do to geopolitical instability up ahead here is also something to be concerned about. But I don't know how. I mean, it's conceivable, I suppose, that we make new highs led by some of the value stocks, by energy and financials, but a little bit hard to imagine. I think you'd still need the technology stocks to really get hot again, and I don't know that that's going to happen with yields going up. Institutional Investor has an article pointing out that, by the way, this notion that technology stocks have to do poorly when interest rates are going up, when bond yields are going up, isn't necessarily so. I'll be looking at that and commenting on it. John, how high now do you see 30-year going, and by when? Well, as I said, the bond market is finally starting to do what I thought it was going to do last year. I thought it would get to 2% by the end of last year, and it didn't do that. And then, wouldn't you know it, the Fed started to become more aggressive early this year, and the result has been a recognition in the bond market that the Fed's going to be raising interest rates. The Fed's not going to be buying bonds. And maybe that's really is the main issue here is the quantitative easing, the buying of $120 billion in bonds per month last year that really distorted the ability of the bond market to give us a signal of correct reading of what's going on the inflation front. And now the bond market, the bond vigilantes are freer to have an opinion. And from an inflation standpoint, 2.5 is still too low. 3.5% may be about right if we start to see some moderation in some areas of the inflation rate, like consumer durable goods inflation. But even if that comes down, as I've said before, we now have a wage price rent spiral, and rent inflation is going to be the troublesome component of inflation for the Fed. I'll take one or two more, and then we'll call it the beginning of the week. Doug, what's your preferred asset mix for a stagflationary environment? I think, I mean, for the here and now, I don't want to have to, whatever your benchmark is, I'd certainly continue to underweight the bonds. Nothing certain, so maybe I shouldn't say the word certainly, but I believe you should underweight bonds. And I think stocks are still a hedge against inflation. And what I've said before, energy is a very good hedge against inflation, and financials are a good hedge against rising interest rates. And technology is a good opportunity to buy in this kind of correction for the long haul. Alistair, given no recession in prospect, are you still happy with your year-end target for the S&P 500? Yeah, I'm kind of fudging it. I'm saying, well, maybe 4,000 isn't my year-end target. Let's make it 4,000 to 4,800 is my range for this year. I won't be surprised if we hit it before. I won't be surprised if we hit it later. But I just don't think we're going to be making new record highs in the S&P 500 this year, notwithstanding the recent action. Obviously, we're all driven by how we see the market behaving in reaction to things. But I wouldn't say there's no sign of recession. I'd say that the consumer on the consumer sentiment index side looks vulnerable. And as we discussed, wages are going up, but prices are going up too. And that's why consumer sentiment is down. So I'm watching the consumer. I think capital spending is still pretty good. I think companies are going to continue to spend massively on capital equipment to offset the shortage of labor. I'll take one more here. Bing, let's see, it's a long one. On the stagflationary outlook, what's your opinion on the potential of morphing into a supercharged PMI growth cycle from all the CapEx that's going to be coming down the pipe from diversification of global supply chains? It's a long question, but it's a good question. Yeah, I mean, there could really be a lot of capital spending, not just because of shortages of labor, but also now because of supply chains moving closer to home, or at least moving to countries where there's a rule of law. And then I presume once things become peaceful again in Ukraine, there's going to be a tremendous amount of capital spending. And then looks like this administration has backed off somewhat on natural gas and now is willing to consider building liquefied natural gas facilities to export to Europe. So it's a good point. Capital spending could really be the surprisingly strong component of real GDP here and maybe around the world. So that's a good optimistic, upbeat note to end on. Thanks for tuning in. Have a great week, and we'll see you next week. Thank you.